I started funding from banks to startup in 2015, and that was purely a personal passion. That maybe I was able to relate to businesses who were in their journey of becoming, say, small and medium enterprises. Remember funding a company which we had the first check from the prominent global investor when they got $7 million in bank, and they were figuring out what to do in a small conference room कि पैसे कैसे utilize करने हैं. So from there, I think naturally we've come a long way. We started our journey in 2018 and it was sub $100 million asset class. And we came up with the first report stating that venture debt should be well known. It should be spoken about. And from there, it has reached now 1.3 billion. So we have grown 13x or beyond in the past 6 years. That's a staggering number for an asset class to come in and grow. Also, by the heart of it, it started as a substitute or complementary tool to venture capital, since we have 3 investors who will speak about it. And the way we transformed over a period of time is that we said, okay, capital is capital. An Accel, Lightspeed, Fundamentum overall gives capital in some shape or form, which is used for, say, marketing, tech, talent, that this is the capital you grow into the business. We give the capital for the actual running of the business, right? It's a working capital, capital expenditure. So you define use cases for the people who are here, especially, I think the media people, right? Because they've taken venture debt as an element of saying, in our minds, in the past 4-5 years, it was suboptimal because it's been seen in that scope of lens. We have made it mainstream from a perspective saying, understand businesses, and it's taken a lot of time for us to go to founders, go to investors. I remember convincing Prashanth in the first discussion, Prashanth use cases pe karenge, and then we kept on speaking about some companies which we had in a portfolio, how we can do it. Some of the companies have grown on acquisitions. So I think that it's a testimonial of what then the results have come out. Because capital is capital, we keep on saying the same thing. We can do a 3-year loan. Venture capital invest for 6 years, 5 years. So how do you want to substitute the capital? But that for 3 years, वो capital कितनी important है उस journey के लिए वो पता होना चाहिए. So in our mind, or at least when I sit across a founder, I just see a founder and say, okay, I have to be an investor in this company. How to structure what's required for the business is a byproduct. Right? Again, repeating that, capital for us is working capital, capital expenditure, international financing. In fact, the Fundamentum has invested in a company recently where we have given rupee mein financing and dollar mein financing, India and international. So I think you define the use cases and that's how you become a partner. To your question's larger answer, I see a gradual shift of venture debt being growth debt. I see a gradual shift of Indian large startups going global. So international financing, and that's the evolution of the asset class.
Thank you. So Prashant, coming to you, how do you see VD playing a role? Is it a complementary role to VCs? Do you see that as a competition to VC? And what is the level of adoption that you're seeing for VD in your portfolio companies?
Yeah, so now it's been 15 years, right, of the startup ecosystem, and this is one asset class or investor ecosystem that has positively transformed itself. So honestly, in the very early days, they were extremely tactical, and so I'm just going to say it as it was. So very tactical and trying to be really safe and just ride on the venture capital's money, right? So for us as an asset class, it was complementary, but I think both of us were.
In a nutshell, he's saying he used to abuse venture debt.
No. I'm saying, but I'm coming to the positive part now. So that's how it started, and it's always good to see the perspective and see how in India. See, I think the reason I'm saying Ishpreet is to give credit to a lot of you who came later, who actually innovated on this product class, right? And I want to give credit for that. But nevertheless, I think so. Initially, like I said, they were just riding on the crutches of venture capital and the momentum that there was, where entrepreneurs wanted to raise these bigger and bigger rounds, and they wanted to just extend the runway a little bit because this was just gave them the opportunity to just raise more money. But anyway, I think that era is gone, and it's I think it's now more business as usual, and the way business should be, right? Which is about how to use capital judiciously. and how do you have the right mix of capital across the spectrum of what is available. And it's great to see that venture debt has filled that void as a bridge between venture capital and banks. And there was this always this this chasm, so to speak, where startups would come back to us and say they want to do X, Y, Z, and the cost of our capital, just to Sanjeevji does not know that because we don't advertise, but we are the most expensive form of capital. Venture capital is the most expensive form of capital, and startup entrepreneurs in their naivety would do all the wrong things and use our capital, and that's because the products were not there. So a long-winded answer, but just to say that whether it is for working capital, and I was just this morning speaking to Ishpreet that now as they've gone up the growth curve in terms of what they're doing and the global capabilities of our companies going global and them helping them, I've been asking him that I see that we will now see a very different startup ecosystem. It's not going to be about urban convenience-led startups anymore. I think that era is done. If we are looking for the next Swiggy, it's not happening in the next 3, 4, 5 years. So we better look for something else. And what do we look for? We are looking to plug into the global value chain. When you want to, as a ecosystem, plug into the global value chain, you got to do startups that are not just about software and AI and soft stuff. They're also about building hard assets, right? And as you want to capture profits in these startups, you want to be deeper in terms of your back end and deeper in terms of being able to do manufacturing where you can, and not just any manufacturing, but high precision, advanced manufacturing. So all of this requires, and of course there is different flavors of this. There is a deep tech flavor, there's multiple flavors, but all of this requires a little bit of asset financing. And in the early stages, startups don't get that financing for assets. So I was just mentioning to Ishpreet that we need to create certain products for companies where demand is infinite today, global demand, irrespective of tariffs in a multipolar world. India will have its place to supply something to somebody, right? We just have to manufacture. And we have to be that country other than China where a significant portion of that value accrues to. Sorry for a long-winded answer, but just to say, suffice to say that I'm really happy with how the product has evolved. There's still more ground on new kinds of products, and I think players like Ishpreet coming into the mix actually moved the asset and this capital class positively, because once there is competition, only then you have innovation.
Great, thanks Prashant. So Rahul, let me come to you. Prashant mentioned that there's a wide spectrum of sort of industries in which there are startups. It's not just deep tech and e-commerce, but also companies with hard assets. So from your perspective, where do you see the need for venture debt? Are there any specific verticals, industries, or companies in sort of startups in their various stages of evolution? Are you seeing a specific need gap where venture debt sort of comes in and fulfills that need?
Yeah, thanks. I think the ecosystem has evolved on both sides, both on the side of capital providers as well as people who are leveraging capital to grow their companies. So while there has been innovation on the capital providing side, I think on the capital consumers, if you will, which are founders, I think they've evolved dramatically over the last, I would say, 7 to 10 years, where they now know this is not an asset class to be used for survival or for running extension. I think people understand that, and I like the framework that you used, Ishpreet, which is capital for growth, which is capital for running the business. I think people understand that. And therefore, if you look at either working capital or asset financing, or even in case a company is through with PMF and therefore wants lower cost of capital, I think smarter founders are leveraging this asset class much better now. In really early stages of the business where discovery is happening and people are still not clear on what the business will be, I think it's a dangerous place to take on leverage. But I think slightly more evolved companies, I think, are understanding that well. We see that happening across, I would say maybe 4 or 5 very, very different kind of sectors. The most primary of this would be commerce, which is manufacturing led, which is India to the world. I think that is where there is a substantial amount of leverage that people are seeking, both within India as well as globally. I think increasingly people come and tell us that, look, I need working capital in the US, in Europe, in Middle East, because that is where my customers are. And, because of the age of the company as well as the domicile of the company, they are not able to access that quality of finance in that part. So that's one, I would say. Second, interestingly, I mean, we are seeing this even in digital products. One of our companies, Pocket FM, is working with multiple sort of venture debt folks in order to build out their business in the US. We are seeing this happening with people who are building more, I would say, operating businesses. I think of it is, a good example I will tell you is a recent investment that we made is in a company called Solar Square. Again, it's technically speaking, you would call it an end-to-end consumer brand, but that is where I think they're leveraging this solution as well. So I would think that maybe the other set, which is people who are not finding this relevant, is perhaps very small now. I think across the spectrum, across the growth phases, barring like the really early stages, I think the rest of it is like very, very applicable.
Thank you. So Ashish, coming to you. Now, Fundamentum is primarily focused on, I would say, profitably growing startups, right? And you also sort of have a much more focus on India. So is there a different lens that you have to venture debt from the sort of, because you tend to invest in companies who are immediately profitable and want to grow?
Yeah, so Manish, I think first of all, venture debt is a fairly interesting asset class. I remember when I was first exposed to this maybe years back, I just couldn't make sense of it, right? And primarily because the question that I was asking was that, hey, you guys are coming in, like what Prashanth was saying and like what Ishpreet was giving a rebuttal to, is that you come in, you piggyback on back of effectively the, let me speak. So on venture capital, and then you also get your money out first. How does it make sense, right? And two things happened, and especially this was true because the use case for venture debt back then was primarily extension of runway, right? Which is the first use case, and I was just not able to fully grasp that. Two things happened since then. One is that since I thought that it was a great asset class for investor, not sure about the founders, I became an investor in one of the venture debt. So that helped me understand the asset class slightly better. The other thing that also happened was that if you look at traditionally venture capital, we have been investing in asset light businesses, right? 10-15 years back or so. But what has happened since then, maybe last 3, 4, 5 years, we have started to look at businesses which have been heavier on the asset. May not be fully heavy, right? So as an example, whether it is manufacturing, whether it is, not shying away from companies with business model which will hold inventory either directly or indirectly, right? So multiple other use cases have actually kind of opened up, right? So I think there is, it is no longer only extension of runway, which also in my mind is a relevant use case in certain scenarios. But, all the use cases that, as an example, Rahul spoke about, right? Whether it is asset financing, whether it is, people want to make acquisitions, so those are all the things that are starting to kind of happen. From an India lens perspective, one thing that always puzzled me, Manish, about venture capital was that when we started traditionally, I mean, you could look at, let's say, Indian capital market, public capital markets, and you will see that hey, there are all of these great businesses which are listed. Why should there? And many of them grew on back of kind of debt, right? Could you not create a new age digital equivalent of that and then effectively use some sort of debt, right? And if you're very early, maybe venture debt or the different sorts of credit instruments that may be available. But we did not do that for a long period of time. It is only now that we are starting to do that. So when I look at it from an India lens, we have not shied away from investing in businesses which have taken and hold inventory directly or indirectly. And this is not only now, even like 7 years back, 8 years back or so. And we saw the use cases for venture debt. So that is the lens that I would probably say, which has been slightly different traditionally, but more and more mainstream at this point of time.
No, so I do see a bit of a healthy tension here between venture debt and venture capital. So I think the discussion can be more
Fortunately,
interesting.
I'm outnumbered. So,
So Prashanth, let me come back to you. So today, I think the venture debt industry is about 20%, 20 to 30%, and we've done this across regions, Europe, Middle East, Southeast Asia, India, across all these geographies, barring the US, I think where it is much more evolved. It is about 20 to 30% of the VC industry. How do you define this state of the industry vis-a-vis VC? Do you think it has potential to grow even further? And till where is the ceiling? And number two, how do you see venture debt playing a role in globalization of startups? Let's say Indian startups who are wanting to grow globally. And you can perhaps take examples from your own investee company. Do you see venture debt playing a role in their growth trajectory internationally?
Just before that, maybe one other use case that I've recently been seeing with some of our companies, and it's not directly something that Ishpreet and team probably have spoken about, which is opening up the companies to banking relationships, and that's been a very useful value add for early stage companies, where Ishpreet and other venture debt companies who have the right banking relationships are giving the banks the confidence, because they are putting their capital in there, for the banks to take a look and be a bit more open in terms of establishing those relationships. So it's a big value add. The second area value add, which we didn't directly address, is in channel financing. I think now with a lot of our growth companies now starting to significantly expand on the ground, whether it's through franchising models, or there are multiple of these expansion models which definitely don't require financing from us. I think we are starting to see some good products evolve there, and I think there's still room for a lot of that. Sometimes related to asset, but sometimes related to retail expansion and some of those areas. So that's good to see. Now coming back to your question on global expansion, and I've been pleasantly surprised when I look at I've always had this overhang that you compare the valley, and of course we don't know much about what it is to really do business in China, but you compare the valley and then you compare ease of doing business in India, and you say, wow, it's so difficult here, this is so complex. But then you go start looking at doing business in Jakarta and Riyadh and Dubai, and you see how not how Stone Age it is, right, compared to where we have evolved. So and some of our companies there have been accessing venture debt, and I'm still looking at the first generation products being offered to them in those geographies. So I think there is a gap there, and one of our companies in Indonesia, for example, is pretty much like infrared market here, but they just don't have access to. There's a company called Brick. They just don't have access to even 20% of the products that Ishpreet is offering to our companies. So, and the same for Dubai, and Riyadh is even a little bit more backward in that sense. So there is a big gap in terms of the stage of where venture debt is in those geographies. And I think being able to, one, as Stride, help our companies that expand there, but also Stride as a product, as a brand, to be able to offer it for other maybe not Indian companies, but other companies there, and expand Stride itself. I think both are great opportunities.
Ishpreet, coming to you. So how do you see the LP landscape evolving for VDs? Is it the same LPs who are LPs for VCs who are trying to diversify their portfolio? Or is it a unique set of LPs? We talked about family offices, this being an opportunity for them to get into, as a stepping stone to get into funding startups. So can you throw some light on how you're seeing the LP landscape evolving for venture debt?
Yes, in fact, we had a small chat in the morning in which Prashanth only brought it up. And I recall naturally that this is a very helpful aspect for LP, but I've been itching to give some previous answer on some thoughts. So I thought I'll cover that. So on Prashanth's point, very important point, asset-backed financing. I think why most of the products, the reason why we went outside, most of the products will get launched outside. One of the products which we are trying to import from outside is asset-backed financing. Because asset-backed financing, Prashanth will be surprised, is very prominent in Middle East and US and Europe. Asset-backed financing is a very popular product for a fintech land, from a fintech perspective as well as real tangible assets perspective. So that's a product which we're trying to get in India in terms of saying, okay, how do we do asset-backed financing, founder buybacks, etc. We've already done last month 2 founder buyback structures. So there are new structures which will evolve going forward, and that's our learning from international, which is already coming in. Coming back to the question in hand, so LPs, we've actually pleasantly been surprised in terms of how LPs have naturally, the reason why we've grown is because of LPs. And they have taken the liking because of 2 reasons. First, the new generation has come in most of the families, and they want to be as closer to tech as possible. They want to understand what tech ecosystem is. Now, how do we help there? So naturally, we are a partner to all 3 of them in their respective portfolios. And they are investing into companies for 5-7 years and with 8-10-year funds. I don't think some of these families are prepared to go long. They're new generation, they're just trying to diversify themselves. Public markets has been their forte, most of them are real estate oriented. Their asset class introduction is happening through this. And that's what we spoke about as well. That how they get to know about what's happening in tech ecosystem. You can get to know while saying, okay, Stride or venture debt funds are agnostic to investing in these companies. You can understand what's happening in consumer, you can understand what's happening in deep tech, climate tech, fintech, through our portfolio intelligence. And then take a judicious call if you want to go deeper in one of them. And second, we are naturally a more stable because it's a 4-5 year fund, there's quarterly flows, it's tangible returns. So actually, from an LP perspective, it's good for both the ends. If you want an Indian startup, to Sanjeev Ji's point, if you want Indian startup ecosystem to evolve, it has to be embraced beyond institutional investors. And the family being adopted to this, make sure that the new generation, one thing which has been a lot of times spoken about is that the new generation is not innovating, they're investing. Right? There's a talk which is going on about that. How do you make sure that you're innovating? You can only innovate when you get attached to what's happening in startups or the new age businesses. Otherwise, you have enough wealth, new generation is coming, they only sit on that wealth and keep on generating returns. So this is the best form from that perspective, and that LPs have taken a liking, and we ensure that they take more liking in terms of creating structures. So that's worked out well.
Thank you. Yeah, sure.
To a point, I feel all new generation wealth should be passed on to the next generation only to create businesses. Yeah. If the next generation is not willing to create business, don't give them money.
Okay, so Rahul, coming to you again. So how do you ensure that the startups don't go overboard with venture debt? How do you maintain a balance? How do you ensure a balance? What is that right balance? Because you as VCs have sort of our stakeholders, you're on the board. and then they might see this asset class as an attractive asset class, which is non-dilutive, and yet gives them access to funds for growth and working capital and so on and so forth. But how do you ensure that there is the right balance, there's not excessive risk being taken on the balance sheet, and what kind of governance would you like to see on that front?
It'll sound little strange, but the closest analogy I can think of it is like bringing up a child requires multiple hands, and different people in the family play different roles, and therefore when at the stages at which most of us go into a company, the company is fairly young, and I think that it requires a lot of work to ensure that the company is taking risks in the business in which it is building and not risks in other things. And I think that governance, you look for elements of that before you go into the company. You want a founder or founders who have high integrity, and moral ethics are not a question mark. At the same time, you create governance structures when you get into a company, both on the equity and on the debt side. And I think I can tell you almost every situation where we work with a venture debt partner, I think we are fairly in sync with the partners on how the investment is going to pan out, what is going to be the utilization, what is going to be the rhythm at which we engage with the company, and what is the kind of information flow that will happen. And yes, I mean, look, the lens with which equity or debt looks at the company will probably be slightly different. But in the end, I think both of us are striving for the same goal, working for the growth of the company. We are serving the founders and the companies, and I think that as long as that clarity is there, it is our job to help the founders understand the governance is there to serve them, not to be an impedance on them.
Thank you. So Ashish, I think my question to you now will be, how do you decide whether a particular financing round should be debt or VC? How would you advise your investing companies to look at this, and how would you help them evaluate this? What will be the decision criteria for them to arrive at a decision?
So if you look at what has happened in the general startup ecosystem in the last maybe 15 years or so, right? Outside the first problem, which is product market fit, people have to understand two more things in business building. The second one has been the right use of capital. And the third is basically right capital structure. And if you think sequentially in our country, maybe the first 15 years back, we were still at a PMF journey, right? Probably not many people understood, how to kind of get into PMF. Maybe 5 years subsequent to that was understanding capital, right capital allocation. So when we look at, let's say, the ecosystem, I feel very comfortable about the fact that most of the companies, good companies, actually understand the first two. The third one, which is the right capital structure, is still people are still understanding, and kudos to venture debt, right, and the newer asset classes which have come up in the last maybe 5, 6, 7, 8 years or so, right, and they have done a commendable job at educating people. Now, whenever we speak to our portfolio companies, maybe 3 years back, 4 years back, they used to always think that if I could raise equity capital, that is when I would raise capital. People did not understand exactly what Prashanth was saying, that that we are the most expensive sort of capital, right? Over a period of time, people started understanding it, right? And people also understood, they went through the journey that there have been companies which raised, let's say, hundreds of millions of dollars, and probably nothing came out of it, right? Either for the investor or the founder, even though the company was of some value, just because they had raised too much of capital. So I think that understanding, I would say maybe the top 20% odd of the companies today, the founders understand this. We don't really have to honestly educate people too much. When they look at their application of capital, it is fairly easy to understand that this is not where equity makes sense, right? And then the great thing about venture debt has been that they have not been fixed about that, hey, this is the the structure that I would follow. They have been very open about, like coming over different structures. And I have seen our portfolio companies actually chatting with people and saying that, hey, if we do this, will that make sense to you, and so on and so forth, right? So there is some product building that is starting to happen. So, and that's probably the first 20% of the capital, right? They say that the best company in your portfolio will be the one where you spend the least amount of time, right? And we don't really have to do anything on those sides. But the next ones, there are other companies, and our job is to, number one, educate from our side, depending on what we think is that, hey, for this, if it is, as an example, growth, growth led by marketing, you effectively, use, let's say, equity. But if it is acquisition, right, especially if the acquisition is net accretive, right, why do you want to use equity, right? You could use debt, venture debt. If you're too small, you could use venture debt. Similarly, inventory is in a big way. When I look at the entire startup ecosystem in the last maybe 5 years, that is one big change that has happened. It is maybe 30-40% of all the companies will have some sort of inventory or the other, right? And I think when we look at it, and then we also actively tell people that, if you can hold inventory in certain ways, and that would actually make your business a lot more stronger, don't shy away from it, and then look at venture debt or some sort of debt, right? And what Prashanth was actually talking about, I think one thing that has happened is that maybe the companies are smaller, they will be exposed to venture debt, and the venture debt funds themselves have been very open about actually opening connections with the banks and so on. So we have had companies which have for different use cases take debt from bank, take debt from venture debt guys, and then there is, of course, the different type of equity providers as well. So those are some of the things that I think there is general awareness in the ecosystem at this point of time.
I can't resist saying one thing, just on a lighter note. The best companies are those where we spend least time because of that. Not because of any other reason. I think there is causality. VCs are very low value add to companies. I'm saying this as a joke, just to be clear. So
and he's speaking for himself.
Of course, I'm speaking for myself.
But in life, the best journeys are the ones where it was not easy, but then you get something really nice. So really, I've seen that. Just as a counter to what both of them are saying, some of the entrepreneurs who've been through a lot and you've been part of that journey really makes you feel nice at the end. What comes easy may not feel that nice.
Yeah. So, Ishpreet, so how would you see the VD industry evolving in terms of so let me back up. Do you need any support from the government, RBI, or any other sort of broader ecosystem to grow this industry? Are there any enablers that need to be put in place in the country?
The Prashanth is sitting on the right hand side of mine, so naturally I can easily get him involved in that kind of support. He's been always at the forefront of. On the evolution of venture debt, I think it will. I think just like any other business, this is a kind of a business which is growing. So it has to innovate, keep on innovating in terms of new products all the time. That's how it becomes intriguing. Also, one more important point, it has to be hand in glove with venture capital community. Because, and I think Prashanth, since we've spoken a lot in his portfolio companies and to him as well, I think the way he has supported some of the companies in thick and thin. And if we had pulled out in some of the cases, right? Venture, because look, you're talking about some positive elements, there's a negative element. The negative element is if we pull out the plug in some cases and take a knee-jerk reaction, what happens to the company? The company, in spite of the fact it has life or it can see the tunnel, see the light at the end of the tunnel, all of a sudden it's lights off, right? So you have to make sure that you're communicating a lot. I think that's an evolution which will go through globally. The one thing which we like at Stride as an opportunity is that evolution of working closely and saying let's educate that we would not come out. And in spite of doing 10 companies, there'll be one relationship which we have to take a call. But at least that communication should be going on. I think Ashish made a small point on that. The communication of saying that we are constantly on top of these companies and because we are monitoring cash flows, we can be more educational for you as well. We can tell you some of the red signals or orange signals before it becomes red quite early. I think that element of evolution is very important because we are observing. There's no point having 100 people in stride and not doing that. So I think that's what the evolution will go through. From the support perspective, as I said, I think SIDBI started with Fund of Fund program, which has been a great enabler. In fact, our first anchor in India and first fund was SIDBI. So you can't thank them enough in terms of the foundational layer as government to start off. But I think there is much more. There can be a lot of allocations of another pool of capital in the similar scope of lens what we spoke about family LPs. That there can be a contribution from LIC or the other initiatives which are owned by government. There are a lot of initiatives now which are coming up. The fund of fund has also increased. Those kind of capital allocation is only good for the expansion. Globally, there are a lot of, again, learning from the global experience, there are a lot of pension funds who allocate. So the pool of capital is very deep. And I think in the last fund or so, we've not maybe a deep dive into any pool of capital or government. I think that's a vacuum which can be filled over a period of time. That's one thing which we'll maybe advocating a lot about.